Do you hold Ethereum? And if so, did you know it's currently in high demand? Demand that comes from not just your fellow crypto fans, but also from large, well-funded institutional investors, hedge funds, family offices, registered trusts, the whole shebang. Although these investors have more financial heft, they are in it for many of the same reasons, to make big gains on their assets under management. I'm your crypto guy, literally, and this is part 2 of a series on valuing Ethereum. In this video, I'll be taking a look at that hot Ethereum investor demand. I'll also take you through some essential tools, sites, and resources that need to be on your watch list. Few things, team. I'm not an investment advisor, so not qualified to give that sort of advice. I produce videos for your educational benefits, nothing more. Also, if you happen to be strolling by the channel for the first time, a warm welcome. I cover Ethereum and other crypto regularly, so if you'd like to see more content like this, do hit up that subscribe button. Oh, and you may also want to tap that notification bell as well. Get these straight from me to you. Alrighty, enough of this foreplay. Let's dive right in. So, why does the Ethereum protocol have value? Well, this is something that I covered in depth in my first part of this series, but it basically comes down to the fat protocol theory. The notion that Ethereum has built a protocol that is fat in value. I won't go into it too much right here, but I encourage you to watch that video if you want to learn more about it. The crux of it is that ETH is valuable because the more that the network is used, the more demand that there is for the cryptocurrency that powers said network. This is the utility demand and is driven by dApp developers, enterprise networks, tokenized stablecoins, DeFi protocols, a large swathe of users. Moreover, with the upcoming launch of Ethereum 2.0, users on the protocol will be able to stake. Not only are they investing in a protocol that has immense utility, but they're also investing in an asset that produces a regular return. All of this makes it valuable. However, this is just the fundamental valuation. If Warren Buffett had a blockchain brother, this would be the closest to the value investing methods that he's used in the traditional stock markets. However, fundamental value takes time to accrue. Real value is hard to price and can be mispriced for a considerable period of time. At the most basic level, though, price is determined by a balance of supply and demand, buyers and sellers, bulls and bears. If one has more dominance than the other, the price will adjust accordingly. In the short to medium term, nothing else really matters. That's why when I try to analyze the price potential of a cryptocurrency, or any other asset for that matter, I like to look at this investor demand. If there is a potential flood of new buyers and bulls coming into the market, it's a positive sign. And in the case of Ethereum, these investors are akin to the bulls of Pamplona, let loose on the crypto markets ready to buy up any ETH lying in their way. Okay, enough hyperbole and hopium. We need some cold hard facts to back up these assertions, so let's take a look at some. I'm sure that many of you have heard of Grayscale. If you haven't, let me give you a quick overview. This is a fully regulated crypto investment trust company. Institutional investors such as hedge funds, pensions, and endowments use trusts as a secure and regulated way to get exposure to a particular asset. Grayscale is well known for running one of the most successful Bitcoin trusts that has well over $3.5 billion invested in it. However, what I'm really interested in is their Ethereum trust. Currently, this Grayscale Fund is the second most popular cryptocurrency fund and has AUM, assets under management, of over $360 million. But it's not just how much ETH it has in this fund, but how it has grown. Over the past year, it's seen an explosion in growth, and in the last 6 months alone, it has bought over 756,000 ETH. To put that into context, that's roughly half of all the Ethereum mined in that period. Those Grayscale clients are lapping it up. But this isn't even the craziest thing about the fund. Over on the open market, shares in this Grayscale Ethereum fund are selling for an amazing premium. At the time of this video, investors were paying a 788% premium to purchase the Grayscale funds over the spot ETH price. This is equivalent to roughly 150% of the Ethereum all-time high back in 2018. So what the hell gives? Well, there are some underlying dynamics as to why this is going on. Firstly, these fund shares cannot easily be traded as they do require a lock-up period of 1 year. Also, those who buy the newly issued shares from Grayscale will have to be accredited. That means that the moment that they hit the open market, they are a rare and unique Ethereum asset. Many institutional investors do not have the mandate to invest in physical cryptocurrency, but they are allowed to invest in regulated trust companies. So, the moment that they find an opportunity to buy some of these shares on the open market, they're only too willing to jump on it. Now, this premium itself does increase or decrease based on the availability of these shares on the market. But the mechanics of why there is a premium is the lesser point. What's more important than the actual number is the fact that at a 788% premium to the spot rate, institutional investors are still buying the shares. They're so eager to get exposure to Ethereum that this price is reasonable to them. If that's not bullish, then, well, I don't know what is. And it's not just these numbers that paint a positive picture. We also have the results of a number of surveys. The most recent on that list is the survey conducted by the Fidelity Digital Assets this June. They surveyed over 800 institutional investors across the US and Europe. The stats are pretty remarkable. Here are some of them. 80% of investors find something appealing about the asset class. 36% say they are currently invested. 60% said that crypto has a place in their portfolio. Now, who would have pictured that positive response even just 1 year ago? When it comes to Ethereum, 11% said they had exposure to it. Now, let's think about that. Given that this was a random sample, we can kind of extrapolate that number out to the broader universe of funds. That is a lot of investors that have exposure to ETH. The survey also found that those investors that were most receptive to crypto expect to be adding it to their portfolio over the coming 5 years. Given that these guys have a lot of assets under management, you can be sure of a lot of buying pressure. Another research report that I want to look at is one that was conducted by PwC earlier this year. This was on the crypto hedge fund landscape and looked at a number of factors, including strategies, AUM, asset allocation, returns, etc. I've linked to it below, but some of the most important insights relate to the growth in the AUM and where these funds had invested said assets. In total, crypto hedge funds saw their AUM double from $1 billion to $2 billion over the year. You also saw an increase in the average size of these funds, with the percentage of funds with greater than 25 million AUM increased from 19% to 35%. All pretty impressive stuff. However, what I want to focus on is what these folks were trading or investing in. Here is a breakdown of it. Obviously, nearly all of them were dealing with Bitcoin, but over 67% were also trading in Ethereum. And it's worth pointing out that these hedge funds are crypto specialists, so the fact that they focus on Ethereum as their altcoin of choice should tell you something. Moving on from surveys and fund stats, I want to take a look now at some essential market data, and we're going to start with some whale watching. What I love about public ledgers is that it makes address auditing that much easier. You can always see exactly how much other addresses have and what they're doing with it. This is also the case for those with sizable holdings, our proverbial whales. For example, one thing that you can look at is the amount of ETH held in the top percentages of Ethereum addresses. There are a number of websites that track this data, but a pretty neat one you can take a look at is sentiment.net. They offer a whole host of other metrics as well, including on-chain, social, financial, etc. Most of the data is free. Anyways, taking a look at the top holders metric over here, you can see that the percentages increased from about 11% in October of last year to over 15% today. If the larger addresses are accumulating ETH at a greater rate than the smaller addresses, that's a relatively bullish sign. Now, of course, we don't really know who these wallets belong to. They could be exchanges, funds, or individual crypto whales. That's why it sometimes requires a bit more analysis of these addresses to come to a more conclusive answer. You can do this yourself, or you can take a look at some fine research that has been done by others. One blog post that I highly encourage you to take a look at is this one by Adam Cochran, linked to below. It's basically a manual audit of the top 10,000 Ethereum addresses and has come to a number of conclusions from it. Two of the most interesting are his findings on whale activity. For one, he found that existing whales have increased their position by more than $550 million in the past 6 months. To give you an idea of the magnitude, Bitcoin was expected to see similar levels of inflow over the entire year for all addresses, not just the whales. Another finding from the analysis is that the number of whales has also been increasing. The author observed that a number of those new wallets in the top 10,000 addresses had their first transaction associated with an exchange, so first buying that ETH. These addresses loaded up on between $100,000 and $250,000 in Ethereum, and they represented about 6% of the holdings in the top 10,000 addresses. So what does all this mean? Well, quite simply, these whales are loading up, stacking their ETH in anticipation of further gains. They are even doing so at a larger proportion than the non-whales. Clearly, they know that something is up. Keeping with some of those on-chain metrics, another set of market participants worth keeping an eye on are the miners and mining pools. These guys run a business hashing for ETH, a business that may be about to end with the upcoming Ethereum proof-of-stake transition. So, what are these guys doing with the ETH that they mine? Well, according to some stats from Sentiment, they are hoarding it. In the first 2 weeks in June, these mining pools have accumulated over 15,000 ETH. This brings the total ETH balance in these mining pools addresses back to just over 1.15 million ETH. Now, the fact that miners are hoarding is an interesting point. These guys have to meet costs, and already margins are pretty tight in the mining game. By not selling their inventory, they could be running at a loss. Now, why would they run at a loss if they don't think that it's worth it in the long run? Indeed, many of these miners may be interested in shifting away from mining rigs and moving towards staking nodes. They'll join other staking pools and node operators when Ethereum 2.0 starts rolling out. Think about it the way a business would think about a capital investment. These miners have taken the view that this Ethereum is valuable. Not only do they think it will be worth more later, but they're also keen to use this capital investment to generate more returns. Smart guys, those miners. Now, it's not just about these investors buying the physical ETH in anticipation of a price increase. They're also actively involved in Ethereum trading in the derivatives market. This could either be to augment their current positions or to hedge particular risk. So I like to take a look at the metrics coming out of the futures and options markets. The liquidity on these instruments has skyrocketed over the past 6 months, and we can glean a lot of info from it. One of the first few metrics that we can look at is the aggregate open interest of Ethereum in both the futures market and the options market. One of my go-to sites for this is skew.com. Most of the data that you could need is free, so it's worth checking out. Here is the chart that includes all of the futures open interest on the listed exchanges. It's gone from just under $300 million in March of this year to over $750 million today. Pretty sizable growth. Taking a look at the options market, it's even more pronounced. Here you can see just how much the open interest has skyrocketed over the past 6 months. Traders have been swamping Deribit and stacking up the instruments. In fact, demand is so great for Ethereum options that a number of other exchanges are lining up to start offering them. OKX recently listed them and have seen a large uptick in trading. One also has to wonder how long it will be before the CME starts to offer these instruments. This given the amazing success that they've had with the Bitcoin options, which have only been listed for a few months. So what this shows is that in the futures and options market, investors and traders are piling in. Of course, open interest and volume cannot really tell you how the market is positioned, long or short. In order to get a better sense of that, we have to look at long or short futures positions and put-call ratios. Starting off with the futures instruments, I have yet to find a tool that aggregates all the positions across the exchanges. However, you can easily observe this on each of the exchanges themselves. If you use TradingView for your charting, then you can calculate the ratio of longs in the market with Bitfinex data. Here I have the ratio of ETH longs to the total longs and shorts on the market. Currently, over 91% of the positions are long positions. This has been trending upwards since the beginning of the year and has never been below 50% at any stage since December of 2018. I had a look on a number of other exchanges and there was a similar pattern. So it goes without saying that if investors in the futures markets are entering more longs than shorts, it's a bullish sign. Moving back over to the options markets, you can take a look at what is termed the put-call ratio. Quick recap on options theory. Call is an option that is the right to buy, and a put is the option that is the right to sell. If there are more calls out, it means that more people are looking to buy in the future, which implies a bullish view. Of course, this is just a very basic understanding of it. I encourage you to take a look at my complete options video for more in-depth explanation. Anyways, by taking a look at the ratio of puts to calls, we can get a rough sense of how people are positioned in the options market. A put-call ratio of less than 1 implies that there are more calls in the market than puts. Thankfully, this is another metric that is well tracked over at skew.com. You can see the ratio over here. As you can see, we're currently just below 0.5, which means that there are almost double the calls as there are for the puts. Bullish. Of course, it's worth pointing out that the Ethereum options market is not as evolved as the ETH futures market, and there are only 2 exchanges where they're easily traded. Speaking of which, if you are interested in trading options on OKX, then I have a link in the description where you can sign up for it. Now, I think it's time to start wrapping things up with a few of my final thoughts on this. As I covered in my previous video on Ethereum valuation, the protocol is immensely valuable. The utility demand for the Ethereum network is increasing exponentially, and this is all price accretive for ETH. Of course, many people know that already. As you can see from the increasing institutional investments into ETH, the traditional investors are warming to not only cryptocurrency more generally, but Ethereum in particular. Their first foray is usually in Bitcoin, but Ethereum is normally their second stop. Miners are also positioning themselves for the larger potential for the protocol. They're willing to run a loss on their rigs in order to invest in the future. It's also based on pure facts, instantly verifiable by on-chain metrics and market data. It's not hopium based on some news report or bullish opinions of others. When people speak with their wallets, that's the most bullish indicator out there. From the retail to the institutional, from the miners to the founders, people are stashing ETH in anticipation of a price increase and the potential to earn some of those staking gains. And of course, you can include me in this list. And that's it, my dears, my second installment into valuing Ethereum. But it's time now for you to do the talking. What do you think of ETH investor demand? Are there any other metrics that I should have looked at? Feel free to hit me up in the comments. Also, if this video was to your liking, then please send them likes my way. I will also regularly be covering Ethereum going forward, so don't forget to smash that subscribe button on your way out. Thanks for making it to the end of that video. As one of my loyal viewers, I have something very important to share with you. Have you heard of my weekly newsletter? It's basically a compilation of all the interesting content that may have flown under your radar. News, reviews, analysis, and hot market tips. Want to be a part? Well, don't delay. Just scoot on over to the description where you'll find a link to my sign-up form. There you can enter your email address. Hit submit and hey presto, you are a Coin Bureau insider. My next newsletter is being cooked up as we speak, one you won't want to miss. See you next time, chaps.